Meeting to order. Item number 2 on the agenda is to approve the minutes of the meeting of July 12th, 2018. Second. Have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item number 3 is the consent docket. Just mention that we've been provided the actuarial valuation. Louise will be here next month to go through it, so you have a full month to review that and get your questions ready for Louise. So other than that, we can take all the items together.
Yeah. Second.
Have a motion and a second on item 3. All in favor?
Aye.
All opposed? Motion carries. Item 4 is to ratify approvals. Have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item 5 is to approve the claims docket. We have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item number 6 is to approve the following applications for service retirement. We have 9 applications this month. We have a motion and a second on item 6. All in favor? All opposed? Motion carries. Item number 7 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. We have one case. We have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item 8 is to receive the report of death, authorize payment of the $5,000 death benefit, authorize the Secretary to make necessary changes to conform on the following. We have 2 cases. We have a motion and a second on item 8. All in favor? All opposed? Motion carries. Item number 9 is to receive the report of death, authorize the Secretary to make necessary changes to conform on the following. We have 2 cases. We have a motion and a second on item 9. All in favor? Aye. All opposed? Motion carries. Item 10 is to approve the following application of vested rights. We have 2 applications. Motion and a second on item 10. All in favor? All opposed? Motion carries. Item 11 is items for individual consideration. We have item A, sending attendees to the Oklahoma Public Fund Trustee Education Conference, September 26th through 28th, 2018 in Tulsa, Oklahoma. Motion a second on item 11. All in favor? All opposed? Motion carries. I might mention Francis just educated me, and anyone attending has to make their own hotel reservations. Is that correct?
Yes, it's on the website that the police department has, or the station has set up for the registration. Either I can do it or you can do it. It's just all right there on the email. If you don't have the email, I can resend it to you.
We can give you our credit card number?
You can, or you can do it yourself if you would
Okay.
prefer. Some people like to do it themselves.
Yeah, okay. Anyway. Okay, item number 12 is the investment consultant report. Patty?
Good morning. We have 3 items that we want to cover today. One is the quarterly report with performance and portfolio statistics as of June 30th. We have the ASAP, which is updated performance through the end of July. And then we also have an asset allocation analysis that I passed out to everybody, which will review the current target allocations and the risk and return expectations. I'll go ahead and start with the Brown book, which is the quarterly performance report. If you flip behind tab 1, gives you an update on the overall total portfolio statistics. I'll pretty much just highlight the pages within this tab, but overall, the overall markets continue to do very well. Economy continues to grow. GDP is strong. Unemployment remains low at some of the lowest levels since the 1960s. And corporate profits are strong, primarily due to the tax cuts that we saw earlier this year. So we still have an economy that's heating up, hasn't started to cool off yet. Dennis and I were talking just a little bit ago about, at what point does the market start to cool down? And there are some things out there that are of concern. One, you have the tariffs and potential trade wars. But also, you have the Fed, who is expected to continue to raise rates until probably the mid part of 2019. And as the Fed continues to raise rates, that's going to impact businesses and households. Many corporate businesses have the highest debt levels in years. And so as the rates begin to rise, that's going to impact corporate profits, and it'll impact the overall markets. Also, as rates start to rise, you'll also have an impact on housing markets, and will impact, households. So you'll start to see a slowdown in the housing market. So there's definitely some areas of concern. At this point in time, the markets continue to rise. This is through the end of Tuesday. The S&P 500 is up 8.1% year to date. The Russell 2000 up a little bit more, just above 10% at 10.7%. The MSCI EFA, which represents international stocks, is down actually 70 basis points, and emerging markets is down 4.9%. So international and emerging markets have really been impacted by currency. When you look at results outside, excluding currency movements, they're better. And so we think that over time, the international and emerging markets will offer more opportunities and advantages potentially into 2019, 2020. So we still think it makes sense to have, allocations there. And overall portfolio diversification will really benefit. But right now, the U.S. economy continues to contribute to overall portfolio results. Just looking at page 22, right behind tab 2, you can see the overall portfolio was valued at $733.4 million as of June 30th. At the beginning of the year, the portfolio was at $736.3 million. So you had net additions, that's contributions, minus withdrawals. So you had net outflows of $11.1 million, and the return on investment, $8.2 million year to date. When you look at that 1 year column, you can see $61.8 million in return on investment. So that's from July 1st of 2017 through the end of June 30th, 2018. You had net additions of negative 23.7%, or 23.7 million. Looking at page 23, we look at the overall portfolio results versus relative returns, as well as risk objectives. And so we want to say, how is the portfolio doing on an absolute basis, but also how much risk are we taking on in the portfolio, and how are we achieving those results? And you can see over the 5 and 10 year columns, you see yeses going all the way down for the 5 year column, yeses for the bottom 3 for 10 years, but no's for the top 2 events. And really what that's getting at is the top 2 lines saying that the portfolio should exceed the actuarial assumed rate of return. So that was recently reduced to 7.1%. Previously it was 7.4%. And you can see over 5 years you're achieving that. 10 years, just shy of that. I think it is interesting to note, and you'll see this when we look at the July ASAP, that 10-year return bumped up 20 basis points. So the 10-year return as of July 30th, 2018, is now 7.2%. So you would be meeting that objective. The other thing we look at is the return versus the policy index. So that's saying how is your portfolio done versus the overall broad markets, and you can see outperforming on both, or outperforming over the 5 year period, but just falling 4 basis points. So it's really in line over a 10-year time period. And then also we look at the risk statistics. So we say, ideally we want to have a portfolio that's outperforming while taking on less risk, that has less sensitivity to the overall markets, while also providing some downside protection. We haven't had too many down years over the last 10 years. Obviously 2008 is still in there, and so that's impacted. But since the financial crisis, we've seen significantly positive returns. But when you do look at that, the very last line is the down capture ratio, and you'll see it's 90.4% over 5 years and 89.7% over 10 years. And so the portfolio is down less than the broad markets in a declining market environment. And then the third and fourth bullet measures risk and sensitivity of the overall markets, and you want to have a lower number there, and you're achieving both that. So you have less risk in the overall markets and less sensitivity to the overall markets. And that's really attributable to the diversification in the overall portfolio. You guys have a broadly diversified portfolio. and also the equity long short and the absolute return. PAMCO's allocation has helped provide some protection and more conservative, more insurance, so to speak, in the overall portfolio and help reduce the overall risk. Looking at page 24, you see the actual versus target allocations. As of the end of June, the portfolio is valued at $733 million. Everything's within the ranges, slightly overweight to equities, 63.3% versus a target of 60%. Fixed income slightly underweight, and real assets slightly underweight. We work with Bob and Tammy on a quarterly basis to rebalance the portfolio in line with the targets based upon the cash needs. And then if anything, if there was a significant market movement, then we may have to make some other adjustments. But at this point in time, we're rebalancing the portfolio based on the cash needs. Page 25 shows you the overall portfolio exposure to emerging markets. So you'll see the very top line in blue, total portfolio has about 9.5% exposure to emerging markets. Most of that is coming from your equity portfolio. Wells Capital and Wasatch, they're your dedicated emerging market managers. You do have a little emerging market exposure in the K2 overseas portfolio, as well as in Lazard and Harding. Those are your international equity managers. And then in the fixed income portfolio, you have a 3.3% exposure to emerging markets. Most of that is coming from Brandywine. They have a fairly significant exposure to emerging market debt. You see 40%, 41.6% there. Page 26 shows you the results of the portfolio year-to-date, 1, 3, 5, and 10 years over to the far right column. Over to the top left, you have the risk-return chart. So ideally, you want to be in that upper left quadrant. That blue square represents your guys' overall portfolio. And so you have a higher return while taking on less risk. So you're right where you want to be plotted. The middle, the total relative statistics kind of in the middle there. You see the up capture, 99.7%. So that says you're capturing, almost 100% of the upside, but the down capture ratio you see is 90.4. So you're protecting in a down market. If the market was down 10%, you would be down 9.5%. And then over to the right, you have the total portfolio returns versus the policy index, as well as relative to the public defined benefit universe. And you can see when you look at the, kind of in the middle there, you have the ranking. Those are your peer group comparisons. So it's another measure that we look at in addition to relative return objectives. We want to say, how is your portfolio doing versus other peers with a similar equity allocation, as well as other public defined benefit plans. Yes. And so very strong. So 1 is the best, 100 is the worst. And you can see over 5 and 10 years, your top quartile. You rank in the 21st percentile over 5 years, 10 years, 26th percentile. So very strong rankings. It's just another measure. So we're looking at the portfolio in many different ways and saying, how's this portfolio doing? And overall, this portfolio has done very well over the last 5 and 10 years. If you look at page 27, you have similar statistics and characteristics. You have the risk-return chart at the top left. You have a similar return as the overall markets, but you're achieving that with less risk. You see the standard deviation is 8.5 versus 9.5, so almost a full percentage less risk than the overall markets. Page 28 shows you the returns. Again, same data, just different chart over 1, 3, 5, 10 years. Page 29 shows you your rolling calendar year returns. So this is rolling 1 year ending June 30th. And so you can see for the 1 year ending 2018, 17, 16, 15, and 14. And the portfolio has been in line with or outperformed the policy index every year with the exception of 2016. So strong performance in 2017, 2015, and 14, and 2018 is in line on a net fee basis with the policy index. Any questions on the total fund performance? I'll go ahead and look at the ASAP, the monthly performance report. This gives you updated numbers through the end of July. It's the staple piece. So a couple things. Page 1, you can see the portfolio is valued at $742.5 million. Continue to remain overweight to equities and underweight fixed income. No major concerns, so everything's within the allowable ranges for each asset class. Go ahead and flip to page 2, and this gives you a summary of the performance by asset class. And so you'll see for the 1 month ending July 31st, portfolio was up 1.3% versus policy index at 1.7%. Year-to-date, portfolio is up 2.45 versus the policy index 2.45. So when you look at the results, August, for both August and year-to-date, large cap equity has been your best performing asset class, followed by small cap. Emerging market and fixed income are the two areas where you've produced negative returns. As I previously mentioned, emerging markets been impacted by currency, and fixed income markets have been impacted, due to the rising rates. So you have an inverse relationship there. As rates rise, you get negative returns, or the prices of bonds go down, and so you have an inverse relationship there, and you see negative returns. But in the long run, higher rates will be better for investors because you'll be investing your money at a higher rate. So over time, that'll be better. Looking at the international results, both Lazard and Harding have done very well year to date. You'll see the international developed markets equity year to date numbers 2.7 versus the MSCI EFA at 0.4%. Harding Loevner has actually produced positive returns while the overall markets have been negative. So they've really helped the international portfolio. Fixed income has also been helped by the allocation to PAMCO. So that tends to be more of an absolute return objective. They're investing in different segments of the fixed income market. They have more flexibility, and that's helped to protect some in the declining market within the fixed income sector. You'll see down 0.9, while the Barclays aggregate is down 1.6%. Overall, as I previously said, the portfolio is doing very well. We have no major concerns. The K2 Mauna Kea platform was recently funded, so we received a distribution from the K2 Overseas Fund at the end of in July, and then those dollars, $60 million, was reinvested in the K2 Mauna Kea platform amongst 11 underlying strategies. That took place. You see that here on page 3 under the long-short equity. You'll see K2 Mauna Kea at $60 million. So that went in at the end of July. It's actually technically invested on August 1st. And then K2 Advisors has $77 million left in it. That will remain there until mid-2019. It's a 10% holdback. So once K2 does their final audit and releases their financial statements, that money will be paid back to the plan. Yes, probably April, May, might be a little less than a year. It just depends on when they release their audited financial statements. Any questions on any of the underlying managers or strategies? The last thing I wanted to touch on was the asset allocation analysis. So as you all know, the actual assumed rate of return was recently reduced from 7.4% to 7.1%. And so we ran the current target allocations in our model to see what the expected risk and return profile looks like for both a shorter-term time horizon, so we say anything less than 10 years, as well as longer-term time horizon of 20-plus years, 20 or 30 years. And right now, we're not making any recommended changes or suggestions. We think that it's going to be tougher to achieve that 7.1% over a shorter-term time horizon, but over a longer-term time period of 20 or 30 years, we definitely think the 7.1% return is achievable. Obviously, a lower investment return is an easier hurdle, but over the next 10 years, just given where we are in this economic cycle and where interest rates currently are, we think it's going to be tougher for you guys and all of our defined benefit clients to achieve their actual assumed rate of returns. And so we want to be sure that the trustees understand and know what the expectations are. So when you look at page 3, you'll see here we put in your current target allocations. So you have a 25% target allocation to fixed income, 60% target allocation to equities, and 15% target to real assets. And what that gets you, you see here the simulated intermediate term statistics, that 10-year median return. That's saying that the median return expectation is 6.07% over the next 10-year period, and with a standard deviation of 10.8%, so it's plus or minus 10.8. When you look at it over a 30-year time period, you'll see that jumps up to 8.24%. So as I was just mentioning, over a longer-term time horizon, definitely the 7.1 is achievable. Over a shorter-term time horizon, it could be a little bit tougher. I will mention, though, when we do this modeling, it doesn't take into account any active management. So this is just assuming that you're earning the rates of return of the market. And so you can see some benefits and value added from your underlying managers. For example, Harding Loevner is generating a positive return this year when the market's down. So typically where you can see the most value added is in small cap, international equities, and emerging markets. Tougher to do in large cap equities and fixed income, but that's where you can see the most, the biggest benefit in outperformance. And so, it'll likely be close to the 7%, but it's likely, and we can talk about this from a probability standpoint, that it's going to be tough to get to that 7.1% over a 10-year time horizon. And you can see that on page 5. This shows you the probabilities of achieving the 7.1. What we modeled here was 6.5%, 6.8%, 7.1, and 7.4 over a 1, 10, 20, and 30-year time horizon. And so what this says is, what is the probability of achieving that 7.1% return over a 1-year period, 10-year period, 20-year period, and 30-year period? And you can see over a 30-year period, there's a 72% chance that you'll hit that 7.1%, but it drops significantly, down to just to 38% over a 10-year period, and over a 20-year time horizon, just under 59%. So the likelihood of getting that return is much higher over a longer-term time horizon than it is over a shorter-term time period. And then on page 6, we also model what is the likelihood of, achieving negative returns over different time periods, again, 1, 10, 20, and 30 years. And you can see that, the likelihood of a 0% return or less is very low over these various time periods. And then lastly, on the last page, we put in your current portfolio value, so the $738.8 million, and we say what will that number grow to over various time periods based on our current capital market assumptions. So again, you can see over 10 years, the 50th percentile, the portfolio will be at $1.3 million, over 20 years, $3.2 million, and 30 years, $7.9 million. So it puts the percentages into dollar terms. Sometimes I think it's easier for people to understand the dollars than it is the percentages. But you can see the growth over the growth in the value over a longer term time period. Any questions on the asset allocation?
Thank you.
Yep.
Anybody have more questions? Okay. Thanks, Patty. Let's see. Number 13, or item 13 rather, on the agenda is comments from board, staff, and citizens. Hearing none, we are adjourned at 10:25. Thank you.